Let's have a look broadly at the context there for inflation, the effect of inflation, 7% rate. Let's look at that rate and perhaps give us the context of inflation in Kenya, because we have varying rates across Africa, and just to get our minds into your environment there, and the effect of that inflation on stock and bond markets.
For one, the inflation fell down significantly to 7% from 10% in June. And that was mainly due to a reduction in the key prices of fuel and foods. And what this happens is that in terms of now inflation-adjusted returns, both in the equities and the bond market, they're much higher than were expected, especially given that the trajectory of inflation is expected to be much lower this year for the second half of the year. So we expect to see a reduction in yields in the bond markets and probably an uptick in the NIC index, as investors now put in the new inflation in terms of their expected inflation-adjusted returns going forward.
Give us the context for the way inflation has been managed in Kenya over the years. Has it been a stable path? And where were the major policy decisions where things were changed?
Well, you have to understand that in Kenya, policy doesn't have much of an impact with regards to inflation, because the key drivers for inflation are the fuel prices and the food prices. So the key indicators are, first of all, whether the rains are good during the year and the global crude prices, and of course the dollar exchange rate. So in terms of managing the inflation, I think the central bank has done a good job, but the key thing is that they have been targeting the currency as a way of managing inflation rather than managing broad money supplies, as happens in other more advanced economies. So I think they've done a pretty good job, but it's an unstable inflation environment, mainly due to the dependence on rain and fuel.
I know when we talk about the currency on the Power Lunch, we almost every day we see they say that the Kenyan Central Bank mopping up liquidity by buying up shillings. Yeah. And is this a trend that it almost seems an indefinite trend?
Yeah, I mean, it seems an indefinite trend at the moment, and one always questions the sustainability of such a trend. However, we expect that now, given that inflation has come down, and of course inflation does have an impact on the exchange rate, and we expect now the pressure on the shilling will be much lower, and therefore the central bank may, going forward, ease up on their repurchase agreements, and even to a point where maybe in the first half of next year they'll be conducting reverse repurchase agreements. So I think the repurchasing agreements will slow down going forward.
Now there's the $1 billion euro bond, the effect of this and the timing and how that will work into the process.
I think it's timely, and they need to expedite this process, because the local money markets are now coming under pressure, given the volumes of redemptions that the central bank and the treasury will need to make going forward. We calculate around 35 billion per month in terms of redemptions, and up to December, and even more going forward, due to the big bonds that were the 2-year bonds and the 1-year bond that were issued last year at high interest rates. So the local money markets need to get some foreign financing so that the government cannot crowd out the local government, the local private investors. However, there's the issue of the ongoing Eurozone crisis, and we might be forced to pay a premium on any debt that we get from Europe.
Talking about Europe, and maybe that's a way of getting into the strategy for the market, stock selection and strategy. Obviously, this week everyone's watching and waiting for the hope for more stimulus from the ECB, and I think there's also a consensus that it's not likely to come. How do you see the Kenyan economy, given what's happening in Europe, and the effect on sectors and therefore selections for investments?
I think for one thing is that there are a number of companies that are exposed to Europe. However, there are also a number of companies who are just exposed to the domestic environment. In terms of the key companies such as East African Breweries, Safaricom, and the banking sector stocks, they're not likely to suffer from a slowdown in Europe, because their key markets in terms of inputs and outputs is in Kenya. And the main companies that will suffer are those ones such as the agricultural farms, the hot tourism firms such as TPS, Serena, and Kenyan, of course. So I think an investor would do well to stay away from those companies and focus on companies whose key markets are in Kenya. And those are the banks, East Africa Breweries, and Safaricom.
Yeah, that's an interesting way of putting it. And I always think of the Kenyan economy, three key things are the flowers, the tea, and tourism. And obviously all of those, well, certainly two of them would be affected by exports to Europe. So getting focused then on particular stocks. Earlier on we were talking about Dangote cement. And that presumably also would be one exposed to local conditions. And looking at the level of economic growth required, what would be the stocks that you would look at?
I think I'd look at some stocks such as the mid-tier banks, NIC and Diamond Trust Bank. They've shown resilience because it was expected that their cost of funds would grow significantly, but they haven't grown they're still at below 7%. And I think that they offer some good value, especially now that DTB is selling at a P of around 5.7 and NIC at around 5. And I think there's significant growth potential in both those two banks. So I take a close look at DTB and NIC. And I'd also start looking at some of the major such as Stanchart and Barclays that were oversold last year.